All righty, traders. Good morning. This is Blake. You are listening to the F.A.C.E show, and nothing like a little bit of napalm and dollar weakness in the morning to get you started, right? Right. All right. Well, we should actually. No, I want to kick off by saying good morning to everybody. What a boring Super Bowl. I mean, if you guys are Seahawks fans, you had a great night. But if you wanted to see a good game, man, I just couldn't stop thinking about that poor 23-year-old quarterback for the Patriots. I mean, geez, 23, and that's a lot of pressure. Anyway, he got a lot of experience last night, that's for sure. But anyway, getting past the Super Bowl, not many of you care about it anyway. So we're gonna go ahead and continue on. There was some pretty big headlines out overnight, and one of the biggest ones, when you got up. Well, when I got up this morning and you're looking at the dollar just really weakening, right? Coming under pressure, and then, the major headlines was, let me make sure I'm in the general chat room here. I think Josh posted it this morning. Let me just show you. The dollar dips on reports that China urges banks to curb U.S. Treasury exposure. And that the timing is appropriate. If you don't know why, I'm going to say the timing is appropriate. There's a truck ton of treasuries getting sold this week, like a lot of supply. We got 30s on the block this week. I believe that's on Wednesday or Thursday. Let me double check. We have 10-year auction on Wednesday. Thursday, we have a 30-year auction, and there's a shit ton of supply coming to the market. And then you got China, one of the bigger, purchasers of U.S. treasuries. You got Beijing saying, don't limit your exposure there. And so that's putting the dollar obviously under pressure this morning. And if you guys don't know the big resistance of the dollar index, I mean, it was huge. It was this 618 retracement and 50% retracement. 50% retracement of the channel, and it's also the 618 retracement of the most recent move lower. So if you weren't familiar with this analysis, it was a big confluence here. You can see huge. This is the 50% retracement of the entire channel, 618 of that. As I was just telling, the folks in our chat room, I mean, you guys know where key resistance is in the dollar now. I mean, it was critical last week as we were talking about it, but now based on price action and what we've seen today, we definitely know that is key resistance. And for some reason, if the data that we get this week, whether it's the retail sales tomorrow, CPI on Friday, jobs report on Wednesday, whatever it is, depending on how good it is, that's going to be a key level to scale no matter what. And that comes in at 98. So if there's anything, if you guys aren't in the Forex Analytics community and you're not talking about this, you might as well just write down that number, 98 in the dollar index. That is key. We one of the things that we aim to do here every show is to give you guys actionable ideas, and that is actionable. 98 is the key pivot for the dollar index. No if and or buts this week. There's a lot of other things that are driving the dollar too. Obviously we got the headlines over the weekend regarding Japan, and then you got the Nikkei breaking out. I'm going to bring in KMan here in a second regarding these election results out of Japan. You're not seeing a huge response out of the yen, because there's been a lot of warnings, and I would argue that it was pretty well known that there was going to be a majority of the seats taken by the LDP. I don't know. I guess the number was obviously pretty big, but but that was already known. And so the yen's response have been fairly limited. Plus, we got a lot of warnings from different officials, and I'll let KMan come in and make mention of that. So, Kay, good morning. How are you?
Morning, Blake. Morning, everybody.
Good morning. So, yeah, we've seen this. Obviously, the Nikkei, we
Mm,
have just blown out to new
yeah.
all-time highs. But the yen and JGBs, a little less response here.
hmm
And let's I'll pull up the JGB so everybody can see. You can see yields. They're not moving like you would have you would have thought. Oh, here goes the euro. Euro's at key resistance right now. We're almost at 38% retracement, by the way. But yeah, you see yields are stronger, but not like blowing out or anything. And the yen's a little stronger this morning. So what's happening with everything here regarding Japan?
Yeah. Okay. So, for those who would have listened to our shows for the past 3 weeks, since Takeichi was rumored to perhaps dissolve the parliament and call snap elections, we've been talking, and I've been calling for her victory, but it's still a very, very big victory. The biggest one since LDP has actually been created, and the biggest single party victory since the wars. What's happened to the yen is that, as you say, JGB yields, they ticked up a little bit, but both her and Katayama have been very quick to say that they won't issue fresh deficit bonds to fund any tax cuts that may be coming. Also, the support that she got as well locally as externally is immense. And that I think is already playing in favor of the yen. This seems to be that inflection point where what happened there is positive. So the positive Nikkei is usually going paired with a lower yen. But what happened today is that it's more like just the positive side of the selection and the confirmation of Takaichi being able to put enormous economic stimulus plans in place. The market not overly sure yet on how exactly the funding will go, but it's all been well traded as well as we've been saying, right? So it's been coming. The market has already put on the trade for weeks, if not months. I mean, actually, this trade has really been going on since Takeichi has been elected back in October, right? But especially over the past weeks, it's been really accelerating because we saw they had the need to intervene verbally and do rate checks just to prevent that trade to go too far too fast. And then they succeeded to calm the game when once the election results started to become very clear. Katayama was very fast in coming out and saying that she will talk to the market if necessary, and that her and the US will be in constant contact, and that they have, and that was pretty strong, a memorandum of understanding with the US, so giving them complete green light to intervene if necessary. So that is now causing this profit taking, I think, in quite a few yen pairs. But we look at the dollar yen, right? That is coming down. But if you look at the dollar globally, the dollar is also coming down. So if you look at yen crosses, they are somewhere in the middle of the ballpark that we saw since, let's say, late last week, but still on the very strong side. So I think the intervention risk may not be completely over, but at least there is a clear positive behind this election result, because the supermajority means that she will not even have to negotiate with the upper house, where they don't have the majority yet, to force all her plans through.
All right, there's another school of thought too that the yen strength may also be that she just doesn't have to put she could be more targeted in like some of her fiscal spend that she wants to do, and maybe not as sweeping. You know, because she knows she can push whatever she wants through
No,
through.
that no, I wouldn't say that because right before the elections, she said like this is no time for fiscal tightness, and that is still a very clear statement. So no, but it's also the fact that she's not going to put these things in place today, right? It's going to take time. She's talking about the summer. So I mean, it's all going to take a bit of time, but I think what we are seeing here, obviously, the JGB yields will probably the longer end will probably stay on the high side because they still will have to fund it. But what I think what we see here is a bit of a vote of confidence that she's got.
All right, all right. Thanks, KMan, for the update. And we'll be watching the end pretty carefully. I was really hoping for a move above 158. If you guys, you know, watch the week ahead video, I have orders like stacked above 158, trying to short dollar yen. But those orders have expired. We didn't reach that high. It's unfortunate. And the gap was just sold pretty quickly, thanks to you know, some of the comments made by Katayama and everybody else. Anyway, Ryan, let's bring you in and talk a little bit about your shit show going on over there in the UK. Tell us what's happening with Starmer, because looks like he's going to stay in for the day at least. What do you make of all this?
Well, firstly, it's not a shit show. This is just everyday life in the UK. This is what we have to deal with. But well, I would say it's probably 70-30% that he stays. He's come out fighting. He has still got a meeting with all of his MPs and party people and whatnot. He's not been getting that strong backing from his cabinet when that's his first line of defence. So as much as he's come out fighting, this is politics. It doesn't matter what you say; it's what everyone else wants you to do. So it's not a done deal that he's going to survive the day, but probably will. But the risk is there he doesn't. But he looks like he's on borrowed time, whatever which way happens.
Okay, well, you know, we've had a nice bounce though in sterling. I mean, people were I think getting a little bearish. You know, I don't know. I want to say too bearish. They were getting.
You can't look at cable for what's going on in the UK. I mean, if you look at euro sterling, it was up trying to break 87.20.
Yeah.
That's more a reflection of you know, pound sentiment. Cable's just rallying with this dollar weakness that we're seeing at the moment.
Yeah, and we are seeing a significant amount of dollar weakness coming through the market, which we'll get to in just one second. But so Euro Sterling's had a nice bounce. It was, I mean, last week we were breaking down and we hit the 127% extension. We created a little false breakdown last week, and it's been kind of squeeze city since. Do you think how are you going to play the Euro Sterling here?
I think if he does end up going, and it happens today, we're probably going to see that up at 88 pretty quickly. And it's just going to inject a whole lot of uncertainty into the pound and UK assets until they find someone who's going to lead and who it's going to be, whether it's someone more to the left, which is going to be more market negative, or sort of somewhere in the vein of Starmer. And then obviously got to worry about what happens with the Chancellor. Does she stay Rachel Reeves, or does she go for someone worse? You know, the market doesn't like uncertainty any which way you look at it. So
yeah, I want to remind everybody that if you're looking at like the 10-year gilt yields, I mean, we're still like, this is not pleasant. I mean, you know, I mean, we're just kind of, you know, locked right up against these highs. So I mean, could we really break out in like 10-year yields, gilt yields? Brian, did I lose anybody?
no, I'm here.
Oh, okay.
We could probably get a move up to at least 5%, maybe through 5%.
Ooh, that would be scary.
Yeah, that would potentially be scary. But you know, we also look at the longer end, and we'll keep an eye on that as well, 30 years and the like. But yeah, I mean, it could be that if this goes, we'll get a period of pound weakness, and then we have to see where that continues with what the economy is doing.
Yeah. All right. Because what happens in the economy actually does matter.
Apparently so.
All right. Well, one of the other things that I think has been a big mover that we need to be paying obviously very close attention to is what's happening in crypto. I mean, I know everybody's like, one of the things about equities is equities have been extremely resilient, and I do want to point out that that we are, and we created a little bit of a false breakdown end of last week. We screamed higher on Friday. One of the things that I was talking about on the week ahead video is just make sure that you guys are very careful with this lower highs that are being created. We're at, by the way, the euro's at the 38% retracement. Guys, if you didn't know, we are right at the 38% retracement here. So this is a pretty big resistance for the euro intraday. We've recovered 38%, and this is, matter of fact, if you are, and I don't think he's here. No, he's not here this morning. If you're a ForexAnalytix subscriber and you've been looking at the Elliott wave analysis, this is what Grega thought we would start finding some pretty big resistance here around the 119 level, and he's looking for a turn lower. And so I think this is going to be really interesting. But the news last night out of China about treasuries is not something that was expected. And Ryan, what are your thoughts about that? I mean, like I said when we first started this show, in case you didn't know, I'm talking to all of our listeners, we are selling a lot of supply this week. We have a 10-year supply. We got 30-year bonds being sold. And you got Beijing out there warning or telling the banks to limit your exposure. So what are your thoughts about those comments?
Well, firstly, as I put in the chat room pretty much first thing, don't get sucked into the hype around this. China have reduced their treasury holdings, and this is talking about the government have reduced their treasury holdings from some 1.3 trillion to under 700 billion over the last few years. So they've halved their holdings. The banks own potentially up to 298 billion, as Bubbles pointed out in the room. The Fed themselves are buying 100 billion, so that tells you the scale of things. China's not telling their banks to fire sale US assets. They're just saying, think carefully about buying new stuff, and if you've got large positions, think about trimming them. They're not a huge player in the auctions as they once were. You've got the likes of Japan and even the UK are up there at the moment. So does it play into this theme of sell US? Yes, if you're in the press, but I don't think it's going to shift the needle a lot on these auctions. But market's going to do what market's going to do with that headline.
Well, I mean, that it's definitely got the attention of a lot of traders here in the U.S. as they're getting up this morning. You can see what the euro has, or excuse me, what the dollar has done just since I've been awake. Since I've been awake, we've seen a pretty big decline in the dollar index. And the euros rallied about 25, 30 pips this morning to that 38% retracement.
Yeah, but treasuries have done that all. Treasuries are up like what, 3 pips, 4 pips?
Yeah. But it doesn't. It's showing up where it needs to show up, right? I mean, but we'll see. We'll see if the bond market takes notice. But again, as you pointed out, what are the treasuries going to do, and how big of how much of the needle is going to be moved later on this week? That's going to be probably the gist of it. But we got to be careful with 10-year yields, just because if 10-year yields start to actually move higher and we actually start to break out now, and I don't know if this is what's going to move the needle, Ryan. I mean, look at what yields have done, like zero, right?
Yeah, exactly, and they've done zero all through this sell US stuff. When the dollar was getting flogged and everything. So I don't know what this dollar move is this morning. It could be on that news. I think it's probably just more of the same of what we've been seeing previously. 1 minute the dollar's in favour, next minute it's getting hit because there's still whatever Trump's doing going on behind the scenes. But yeah, what this 119 is a pretty decent level up here in euro dollar. But yields wise, really keep an eye on the midpoint. We got we've got two ranges, this 390, 4% and 420s in 10s. And then you've got the 420 to 450 with the 430, 435 in the middle. So yeah, we could be up for a bit of ranging.
Hey, just in case you guys missed this as well, I was talking to Craig Shapiro from Ninja Trader yesterday, and we were talking about all of this supply coming online. And just now, Google says they are looking to raise $15 billion from U.S. bond sales. I mean, there's a lot of paper trying to get sold right now, and somebody's got to take it on, or yields are going up. And so this is an issue that we're going to have globally. It's not just the US where yields start going higher. You got companies trying to raise money. You got other countries that are trying to sell. And in order to attract capital, because we're not getting it from China, yields have to go up in order for that, to attract capital. So just a little heads up, guys. I mean, there's a lot of funding needs that this world needs, and probably lack of funding, and that means yields are probably going to go up globally, and that's going to be an issue for markets. Not right at this very moment, but it's something that we should be thinking about moving forward. Now we have data coming out this week that should be moving the needle. Like I said, we got jobs report on Wednesday. We have retail sales tomorrow. We got CPI on Friday. I do want to talk to these guys, to Ryan and KMan, what they think the most important data is going to be this week. But I do want to go back and reference really quick crypto, because crypto looks so weak. And real quick before I forget about it. One of the things about Bitcoin is we broke this 75,000 level. This is the previous breakout point. It was that big cup and handle neckline. Everybody knew that was the big breakout point. And it really took, the trader, like anybody who was long to the cleaners, on a break back below 74,000. That seems to be key resistance right now because it is a 38% retracement. But the scary thing is with crypto and with Bitcoin, we haven't even been able to test it. And that's scary. I think that's something that everybody's got to be paying attention to right now, that we're not even able to get up to a 38% retracement, which does suggest that we are heading lower in crypto. Ethereum can't get back above this 21.5, 2,150. It's been a big pivot for a long time, going just keep looking left. You can see how big that level's been. We have not been able to get above that today. And even though stocks are higher and futures are higher, these cryptos still look like crap. And I just want to reference it because if you're out there buying crypto thinking this is a good deal, it might be one of those goodbye, oh boy, crypto's a good buy here. Yeah, it's goodbye house, goodbye car, goodbye wife, goodbye dog. That it might be that good buy versus the other good buy. So, and it might be good bye-bye, goodbye. Ryan, what data? We got jobs data, we got CPI, we got retail sales. What should traders be focusing on this week as far as what's going to drive the markets this week? What do you think is the most important data?
I think it's going to be the NFP if we get a decent number out of it. And we were talking about this on the Flow Show. We might campaign to have NFPs on a Wednesday more often, because what happens is when we have it at the end of the week, it's sort of, you spend all week waiting for it. The market does nothing, and then you got to wonder what you're going to do on a Friday afternoon. So this time being on a Wednesday, it could give us something to trade for the rest of the week over the Fed and whatnot. So
you know what, you bring up a really great point, Ryan, because I want to say that one of the things about non-farm payroll on a Friday is you get, like, for everybody. I mean, it's especially if the data is really good or really bad, whatever it is, especially if you get some surprise. You get really one-way markets on Friday because once Europe goes home, once you guys are done for the day, and usually after about an hour, of trading after the data comes out, no one wants to fade it. So,
Yeah,
I mean, it's kind of easy to trade because you're like, oh, the dollar is weak because it was a miss. The dollar just ends up grinding lower for the remainder of the day, or flip side is great number, dollar just grinds higher for the remainder of the day. But it's not a lot of volatility because everybody's like, well, I'm not standing in front of it, and I'm going
exactly.
to go home for the weekend. So yeah, maybe this midday midweek NFP would be great.
Yeah, and then we got obviously the icing on the cake with CPI on Friday, so you can have your little your little one-way boring move in the afternoon. But no, it presents a good opportunity. Trade the NFP, see what the market does with that, and if the CPI offers something different, then you get a bit of reversal to
Yeah,
whatever's
and by the
happening.
way, guys, I don't know if you guys have seen it, but the euro is trading at basically 119. It just continues to grind higher into new highs on the session. KMan, what do you think as far as the data goes? I mean, yeah, the jobs report on Wednesday. How important is the CPI data
Yeah.
on Friday?
We just had a comment out from Hassett saying that we should expect slightly lower job numbers. Lower job numbers shouldn't trigger panic. Watch this space.
Oh, wow. Did he
uh,
just say that? Oh,
yeah,
I
that's
did. I
why the
see the
dollar got
comments
another
now.
little slap around the neck. Um, I think the jobs are going to be more important. We sort of got the well, I don't know whether inflation needs to come out either very sticky or drop off a cliff a little bit to really materially change. I think the market is really going to be focused on jobs because that was the what we all expect. Are we finally going to see the job market fall off a cliff with all those layoffs that have been talked about by various very big companies and that very weak JOLTS report that we had, big challenge layoff. So now the market is going to want to see whether it materializes into a weak NFP report. So I still think that NFP is going to be the more important one of the two. What I think as well is going completely under the radar is that Wash has been toying with an idea of reshaping the accord or forming a new accord with the U.S. Treasury, which would, it's not being said in so many words, but I've posted the article in our newsroom, and I spoke about it last night. And it was one of the reasons why I sold a few dollars last night as well, is that if you give more power to a treasury which needs to fund all the deficits, if you give them a little bit of oversight of at least something to say about the Fed bond holdings, etc., or the runoff of the balance sheet, which is linked to it, it may give people an idea that less Fed independence, more of a say of the Treasury in the money. Is probably going to be a negative for dollars as well. And then Bessent said yesterday that he expects the central bank to move cautiously in any effort to trim his balance sheet. And he then also said Wash is going to be very independent, but mindful that the Fed is accountable to the American people. And I think it's been completely, at least for what's been turning around in the market, it's been reduced in importance compared to what the Chinese have said, but I think it's part of the game. I think it's
Okay.
it's been.
Yeah, I mean, it is. I guess it is just part of the game, isn't it? All right. Well, thanks, K-Man. And yeah, if you guys aren't, again, if you're not having these conversations with traders, or you're not being able to put, 1+1 = 2 together in the markets, you should be jumping in the ForexAnalytix chat room. You have access to, the like news that and research that K-Man was posting in the news and research room, having conversations with not just myself, not just Kay, not just Ryan, but with traders all morning about why things are moving and how they're moving. You should be in our chat room because that's what we're doing 24 hours a day. Hey, we're gonna bring in Michael Brown. Let me see if I can find him really quick. Great interview today. And Ryan and KMan, you guys are more than welcome to stick around. I'm sure you guys are going to have some questions for Michael. Ryan, can you find Michael in the participants, please?
Yeah, let's have a look.
Okay, so while he's doing that, Michael is in our chat room. We love having him there. He is in the UK. You guys probably remember him. I interviewed him for years now. Shit, I can't even remember what. Michael, good morning.
Hello, good morning. I thought you were just going to leave me sat here like a spare one at a wedding for the rest of the afternoon.
Hey, it's good to hear your voice, buddy. And we're gonna keep Ryan and KMan here for a little bit at least. But what was the name of the company that you used to work for before you went to Pepperstone?
I was at Caxton first, and then I moved here 3 years ago. Feels like 30.
Yeah, it feels like 30. Well, if you have to work with Westy every day, probably.
Exactly.
I love Westy. You
Say
guys
no
know
more.
that. But yeah, Caxton, Caxton, is that what they were?
That's the one. Let's not give them too much free advertising, mind. They're not paying my wages anymore.
Yeah. But the thing is, they fell off the face of the planet now that I don't even know who they are. I forgot their names.
Well, when the main man leaves, you know.
So anyway, well, hey, I wanted to, and I was just gonna keep Ryan and KMan around for just a little bit to see if they had any questions for you before we start talking about your labor market predictions that you've been discussing. And I have to admit, you are usually just a bull, and you always are a half glass or glass half full kind of guy. But you've turned a little sour on the U.S. labor market. I want to dig into that in a bit. But before I let Ryan and KMan go for this interview, I wanted to see if they had anything for you. Let's start with KMan before he has to step out. KMan, we got Michael Brown here. Any questions that you might have for him?
I haven't thought of any, Blake. I wasn't advised about needing to prepare one. Otherwise, I would have done.
No, you didn't have to prepare anything. It's just anything top of mind that you'd like to ask him.
Well, I mean, the simple question is, when is Starmer going to get the boot,
Well, I mean, this morning when I came to the desk, I think I was measuring it in months. I was still of the view that he can kind of muddle on until the local elections in May. As the day has progressed, it feels increasingly like we might now need to measure that in days. We're looking at the Scottish Labour leader going over the top and calling for Starmer to go. The Welsh Labour leader is probably going to do the same. He's lost his chief of staff and his chief of comms in the same day. I think the only thing stopping this from accelerating even more quickly is the fact that there is no particularly credible replacement just sat waiting in the wings ready to go. Otherwise, I think you could probably put a fork in him already and he's done. But this is clearly getting to as well as the political editor of The Sun said earlier, it is kind of getting to the end of days point, I think.
I was going to ask, and real quick, and I'm sure you guys probably have thought, is this all fallout from Epstein? Is that what this is?
Yeah. It's, I mean, obviously Starmer's been on borrowed time for a while with all of the U-turns and various other bits of chaos that have been going on, as Ryan sort of alluded to earlier on. But I think this is the first time where one of these issues or scandals, whatever you want to call it, has actually seen Starmer's personal judgment pulled into question, because it was his decision to appoint appoint Mandelson as the ambassador. That's a bit of a Freudian slip, despite all of the allegations that were going on. And I think that's really called his judgment into question and sort of acted as the straw that's broken the camel's back.
All right, KMan, I didn't mean to jump in there, but I was like, something I had read about Epstein. I'm like, man, this guy's reach, even past his death, has been far and wide. Okay. Oh well, sorry.
I completely missed that.
Yeah, it has been. Hey, Ryan, did you have anything that you wanted to ask Mr. Brown? Because I know you guys like to harass each other as it is.
Yeah, of course.
Non-football related.
Got a long list.
Oh, long
list.
list. All right.
Oh, no.
Let's let it rip.
Number one, since you're talking about the jobs market, see if you can get a number out of him for the NFP competition.
Oh, well, you can ask him yourself. Yeah, what's up with that,
Well,
Michael? You got the last one, always the last one to throw a number out. I mean, come on, you could be early this
I
time.
just like to keep you guys in suspense, but as I just said on the desk, whatever your guess was going to be, I'd lop a few thousand off it, given that you've got Kevin Hassett coming out 48 hours before the jobs report saying we should expect slightly lower numbers and lower numbers shouldn't trigger panic. If the NEC director's saying that, I think it tells you about which direction of a surprise we're going to get on Wednesday.
Well, maybe Kevin Hassett just read your piece from last week.
I would love that to be true.
All right, Ryan, what else do you have for Mr. Brown other than harassing him about putting out a NFP guess ahead of time?
Yeah, no, apart from that, just how many lunches has he got booked this week? That's usually the other question.
Actually, only one. I am out tomorrow.
Oh, there we go. Shock.
Yeah. Get yourself up to the city. I might take you out if you're lucky.
Ooh, what? Once you lose another bet?
Well, yeah. End of the year then.
It's going to be a long year, gentlemen. It's going to be a long year. You know, Michael, I really appreciate you joining us here on the F.A.C.E show. It's not often that we have you here, so really nice to have you here this morning. Let's dig into the jobs data now that we've gotten all the jokes out of the way. You have turned a little bit more sour on the labor market, and I'm gonna pull up some of the numbers from the BLS here really quick. But as I'm doing that, what has been your cue, and why is it that you are looking at, you know, and I know this is from last week, even before we got the big Challenger layoffs number, because people can go, well, you know, of course, in retrospective, you know, look at him like, you know, being all bearish on the labor data after last week's data. But you wrote your report like literally like a week and a half ago. So why don't you tell us a little bit about why you're turning so negative on U.S. jobs?
Yeah, absolutely. I mean, I put this note out last Monday morning, and then, you know, mercifully we had a soft ADP number, pretty dismal JOLTS figure, and the Challenger layoffs that all kind of reinforced the idea. Which, you know, I'm not overly happy to see bad labour market data, but it's always nice when you're on the right side of the argument. I think what we're seeing is a labour market where the headlines are pretty decent. If you look at just the data you've got on your screen there, unemployment is holding steady at 4.4%. Headline payrolls growth is kind of ticking over at 50-ish, 60,000 on a month-on-month basis. The problem with that is when you start to dig under the surface a little bit and look at what's driving those numbers. So if we look at the unemployment rate for starters, we had a cycle high 4.6% in October, and we're now back down to 4.4%. The only reason we've come basically 0.2% lower, and actually slightly more if you dig into the decimal places, is because the size of the labour force has fallen. Participation has fallen. And that implies that rather than unemployment falling because people are getting jobs, unemployment is actually falling because people are giving up looking for jobs, which is far from a bullish sign about how resilient and robust the US labour market is at this moment in time. And that's why you see things like the Conference Board, where their jobs hard to get index, that's at its worst levels since I think 2021, if not 2020. And also why you start to see consumer sentiment rolling over as well, because you know, consumers are much more pessimistic around their bargaining power in the labour market. You then look at headline payrolls growth, which, as I said, has kind of been hovering around this 50-ish, 60,000 mark, which you'd argue is the break-even rate. But actually, if you look at the composition of those jobs, that jobs growth, they're all coming from healthcare. So in 2025, if the healthcare sector is taken out, the US economy added just 20,000 private sector jobs. Now, I completely understand the argument of you can't just arbitrarily add and subtract sectors to figures to support a certain argument. However, I would argue against that healthcare is not cyclical, it's not interest rate sensitive, it's very domestically focused, and employment in the sector just mechanically increases every month and will increase probably every month forevermore because the population is getting older. People are getting sick, people are getting old, they require care, employment in the sector expands. If you look at those sectors that are really a proxy for labor demand, there isn't any, frankly. And I think my sort of concern is that you read not only the last FOMC statement, but the remarks from Fed Chair Powell at the press conference. The sort of core of the FOMC seems to be taking a lot of solace in this idea that the unemployment rate is steady, which means that the labor market is fine. However, the unemployment rate is steady for the wrong reasons. The labor market is only adding jobs because people are getting older. Layoffs are increasing. Companies aren't hiring. We're sort of on the cusp, I think, of a stage where you could easily see a sort of, well, to coin a fancy macro term, a non-linear rise in unemployment, which is basically things fall off a cliff quite rapidly, at which point the Fed are quite a long way behind the curve. Yes, they've got a lot of ammunition if they want to deliver it, but they appear pretty sanguine at this moment in time.
Okay, and look, talk a little bit about this problem that and I know we're focused on the U.S., but it's probably more of it could be a little bit of an issue, globally. The lack of migration. How's that going to factor into the U.S. jobs market?
The lack of what? Sorry.
The lack of migration or immigration, rather.
Oh, right. Yeah. So I mean I think that has largely already factored through, and that's a constraint on labor supply as opposed to a constraint on labor demand. And that's why you look at something like the break-even payrolls pace, which is effectively the number of jobs the US economy needs to add every month in order for growth in employment to keep up with growth in the labor force and keep unemployment steady. If you go back to maybe 3 years, the break-even payrolls pace was around 220,000.
Yeah.
That is now probably between 30 and 50,000 because you've got much slower pace of growth in terms of the labor force. So that is why I think we've probably gone through this phase now, but certainly last year when we were getting payrolls prints in the double digits as opposed to in the triple digits, a lot of participants were looking at that and going, well, that's worrying. Well, actually, it's not impossible, but it's very hard for the US economy to add 200,000 jobs on a monthly basis now because there simply isn't the supply of labor available to do that. So we just need to adjust our expectations a little bit as to that changing composition of the labor force. And of course, all the time that the immigration enforcement remains at the sort of strict levels that we're currently seeing, that constraint on labor supply will remain. But of course, on the other side of that does give work that should engineer higher earnings growth, although we're not entirely seeing that at this moment in time.
Mm-hmm. All right. Well, so if I had to just, my takeaway from this conversation about the U.S. Labor markets, you feel that it is going to deteriorate from here, and the scary thing is it could deteriorate quite rapidly moving forward.
Yeah, I would say there's a significant risk it will deteriorate rapidly from here. I mean, what we tend to see is, when unemployment starts to rise and sort of get a little bit of momentum, it's relatively hard to turn that momentum around, particularly if you're delivering monetary support after that rise has already begun to happen, as opposed to in anticipation of it. And actually, Fed Governor Chris Waller had made a really good speech a fortnight ago explaining his dissent at the January FOMC. It was very much in line with what I've been saying here around the anecdotal reports he's been hearing in terms of layoffs, in terms of how the composition of jobs growth is really not reassuring. And another thing a lot of people are looking at is jobless claims. People are pointing to continuing jobless claims have been pretty much flat for 6 months, 12 months. The problem with that is, and you'll know this better than anyone, Blake, because you're in the country, you can only claim unemployment insurance for a maximum of about 6 months in most states. So the problem when you get to the end of those 6 months, either you've got a job and you fall off the jobless claims list, or you haven't got a job, but you're no longer eligible to claim. So you also fall off the jobless claims register. So again, it's that kind of idea that potentially we're looking at these labor market signals providing false reassurance to policymakers and potentially to markets as well.
Yeah, and one of the other things, and I should ask this before we actually move on, is the gig economy. There's a lot of people. I actually had a mutual friend of another friend that I've known for quite some time, and he lost his job of like 25 years. He ended up being an Uber driver and Uber Eats driver for like literally about 8 months before he actually found another job. And I was like, but that's the story of a lot of people, right? I mean, a lot of people are finding work in the gig economy, and that doesn't really factor into any of the official data that we get.
No, and that is going back to your previous point, that's actually a kind of global issue where tracking what's going on in that gig economy or the among the self-employed is really, really difficult. So I agree, there is probably stuff going on that the BLS report simply does not capture. Whether that explains away all of the weakness that we're seeing, I would be, I would be skeptical that is the case, but I think there's definitely a degree of that going on, and we shouldn't underestimate the impacts. The other thing that it's worth bearing in mind in terms of the other signals that we might be getting is traditionally we would go a relatively soft underbelly of the labour market is actually bearish for the economy at large, because you would assume that consumer spending hinges on consumer spending hinges on the labour market being tight and people having confidence in their future employment backdrop. But when you've got this idea of a K-shaped economy where actually 50% of spending in the US, consumer spending, is coming from the top 10% of earners, actually the pace of consumer spending doesn't depend on the labour market. It depends on how asset markets are performing, whether that be equities, whether that be property prices, or whatever it may be. So again, that sort of traditional correlation is starting to be weakened a little bit.
All right. Well, thank you very much for pointing all that out, Michael. Let's shift gears over to what's happening in Europe, and I don't want to necessarily focus on what's happening in the UK, but over the weekend there were some election results in Spain and in Portugal. And it seems like a lot of elections are, they're starting to lean a little bit further to the right. Is that correct?
Yeah, I think that is correct. I mean, the UK, as we can get onto that, is kind of going in the opposite direction. But yeah, you did start to see that coming through. Although I think for Europe and from a political perspective, the election story is really a 2027 one, because next year we get elections, national elections in France, in Spain, and in Italy. They are 2, 3, and 4 in terms of the largest economies in Europe. So
Yeah.
that's really going to be the big test for markets as to how the public and how those voting trends are shifting. But the direction of travel does seem to be rightwards at the moment.
All right. Well, what is that going to do for your outlook on the euro, on currencies just in general? I'd love to get your views just on how you feel about where we sit in the FX market globally, and do politics factor in at all?
They do to a degree, although I would argue that actually politics in the US is probably the biggest consideration for FX participants at this point, because you're looking at a market where there are a lot of fundamental reasons to want to be long of the dollar. Yes, we've just spent 15 minutes talking about downside labor risks, but
Yeah.
presuming that they don't materialize, the US economy, in terms of a growth outlook, is likely to vastly outperform that of pretty much anywhere else over the next 12 months or so.
Sure.
You've got an easier monetary backdrop, and you've also got all of the fiscal stimulus coming through from the One Big Beautiful Bill Act as well. The problem is markets can't focus on that when you've got such a huge degree of policy volatility coming from Washington, D.C., whether that be on the trade front, whether that be geopolitical, wherever it may be coming from. We all know that this kind of art of the deal, escalate to de-escalate thing, that's how that's how Donald Trump seems to want to do things. The problem is you've always got to price the risk that actually it's just escalate, or he does go all the way and implement a tariff. And that's really leading participants to reassess their exposure to the US, and also reassess their dollar holdings. And you were talking earlier on about the headlines that we had out of China in terms of looking at their treasury holdings, that's just kind of the latest piece of that massive puzzle that's been going for a while and is going to keep going for quite some time. So I think unless and until we see the sort of volume dialed down on that front, it's pretty hard to be long-term bullish on the dollar, which kind of forces you into the uncomfortable position where you're going, there's really not much to like about the pound because, 3 miles from me in Westminster, it's descending deeper into shambles by the minute. There's not much to like about the euro because you're kind of betting the house on German fiscal stimulus working out, which feels a bit uncomfortable. So you're almost in this situation where by default you are long of these currencies, not because there's anything particularly glowing about them, but simply because it's quite tough to be long of the dollar at this point.
Yeah, and that's been kind of the theme, I would say, probably for the last year. I mean, people are just like, I don't really want to buy Europe for all the reasons that you pointed out, but at the same time, at least I got some stability here, and where there's a lot of volatility for the dollar, as you pointed out. Let me ask.
And a lot of it, sorry, just to,
a
lot of it will be mechanical as well. If we're talking about international investors trimming their US exposures, well, that all needs to be repatriated somewhere because if you're trimming down your treasury holdings or your equity holdings, there's no point just holding dollars in cash because that defeats the object of what you're trying to do. So those massively overweight US positions that we've all run for a decade or a decade and a half, as that's all repatriated back to home country, then it's naturally going to cause a ripple effect in the FX space.
Yeah, and apparently it's all going into the Nikkei overnight. So maybe that's where all the money's going. Hey, I know just because Westy told me that 80% of your holdings that you make at Pepperstone go directly into Bitcoin and meme coins. So I know you're a huge hodler. I'm joking, guys. I'm harassing Michael because I know he is not a crypto fan, and
I was going to say, if that's true, my bonus has just dramatically shrunk.
but I know just because we talk to him in our chat rooms all the time. You're not a big crypto fan, but I think I find interesting is you've seen this big move in crypto lower. Obviously, we've witnessed it over the last 2 weeks. It hasn't really affected global equity markets at all. Are you surprised by that?
I am to a degree. I mean, I think I would, so actually broaden the conversation out a little bit. Well, one, because I don't want to talk about crypto, but also I think what we've really seen is kind of the speculative stuff that participants were just playing around with has rolled over, whether that be Bitcoin, some of the other cryptos, silver, gold, software names, tech stocks, everything that was kind of one of these really crowded, slightly speculative or very speculative momentum trades have all just kind of rolled over at the same time, albeit to varying magnitudes. And I think that's just a sort of reflection that actually these positions were very crowded, they were very stretched, and as momentum has turned, you've ended up with sort of this vicious cycle almost, which has driven the prices of all of those various assets lower. As for crypto specifically, you're never going to get me to sit here and say buy the dip. I mean, where are we trading now? 69,000. I think it's probably still $69,000 too high, to be honest.
Yeah, but yeah, we are seeing the speculative stuff get whacked. It's whether it's LIFO, last in first out, type of investment thesis going on, but I thought it would have a little bit more downside risk on equities, and U.S. equities are. I mean, the S&Ps is still we're really at all-time highs. I mean, you can say
I mean it's
off
been
today, but
contained. It's been contained. It hasn't been. Please, no one play this back in a week if everything's fallen off a cliff and we're all ducking for cover. But
pigs flying.
It hasn't been systemic. We've seen a position unwind in silver, we've seen a position unwind in gold, position unwind in Bitcoin, whatever. It hasn't been a case of a broad deleveraging or a broad degrossing and a taking down of exposure to risk assets. What I would say about the US equity space at this point is actually at the same time as this has been going on, we've been seeing a lot of churn and rotation under the surface. So the S&P is at 6,900 this morning. We're probably 2% off a record high, whatever we are. But at the same time, we've seen this big rotation out of tech and out of the AI names, out of the semiconductor names, out of the software stocks, and into cyclical names, into value, into companies that are exposed to the real economy. Now, the sort of issue with the way that the S&P is constructed is the top 10 firms in the index, 9 of which you can reasonably describe as tech names, have a 40% weighting. So when you've got all this churn going on under the surface, the S&P almost mechanically is just going to be flat to marginally lower, even if you get days as we had last week where 55, 60, 70% of the index in terms of the individual constituents actually end the day in the green. And I know you've put the Dow on that screen just to annoy me, but it is actually outperforming as a result.
It is. It's at all-time highs.
Russell.
Yeah. Yeah, and
Indeed.
the Russell. I'm doing it not to annoy you, but just to show the outperformance of, like, you know, real companies that make real money and have real earnings, right? As you're pointing out.
And you've got kind of two things going on. You've got factors that are pushing people away these tech names when you think about, you know, concerns over all the capex that's coming down the line, both Alphabet and Amazon last week saying they're going to spend 200 yards on capex over the next year. Alphabet doing a bond sale today, worries that the sort of moat around software companies might be eroded by companies like Anthropic and Claude. So that's kind of forcing people away. But at the same time, you started to see US data actually improve. Again, setting aside what we said about the labor market, in terms of activity, we had a 4-year high on the ISM manufacturing. We had a better than expected ISM services survey last week. If you look at economic surprise indices like the one that Citi put together, US data is surprising on an activity basis to the upside by the biggest margin in 2.5 years.
Yeah,
so if you're kind of going, actually, can you give me textbook conditions to rotate into cyclical stocks? Well, kind of looking at them.
That's true. It's a great point. Michael, I'm going to wrap things up here, but I want to just circle back to our team with Ryan and KMan. Did you guys have any other last minute questions for Michael before we let him go?
No, not for me. He's covered a good ton of things, I think.
Yeah, yes.
You know what? That was almost a compliment.
Almost. Almost.
KMan, did you have anything for Michael?
No, now that we know everything, we have somebody to blame if it doesn't work.
Right, exactly. I cannot wait to replay this in a week from now.
You have my permission to do that, and I will end up with egg on my face. Don't worry.
No way. You know, Michael, it's always really a pleasure to sit down and chat with you. I know we've obviously, you know, been talking for years upon years. When you were over at Caxton and as you made your way over to Pepperstone, which you just do an amazing amount of work over there and great work. How do people get your research reports from Pepperstone? The ones that, you know, we're you know, some of us in our community are privy to, but how do people get your work?
Yeah, they should all be on the website, which is pepperstone.com, which I worryingly almost forgot then. You go to the research section on there, you'll find all my stuff, or just reach out to me on LinkedIn or Twitter, and I can get you hooked up with email lists and all the rest of it.
Awesome. Yeah. And so make sure you guys are following along Michael Brown. He's a great follow, has been on Twitter for years upon years upon years. You know, he is, you know, now quite a staple in the ForexAnalytix chat room. We love having you there, Michael, and being able to talk everything and everything markets. And, you know, and I know Ryan loves to, you know, have a great time with you on the trade-off and other shows that you guys do. So thanks for being part of our community, but, you know, blessing the trading community with your presence. We all do really appreciate it.
No, it's a pleasure, mate. Thank you. Thanks for having me.
Yeah. And guys and gals, I'm gonna wrap it up here, but I do want to just note really quick, the euro's trading above 119, you know, and the dollar still looks pretty vulnerable here, despite, you know, Bitcoin being weak, despite equities starting to roll over. So just kind of a heads up. Michael, thank you so much. Ryan, KMan, thank you guys for every day on the Flow Show. And I want to, you know, wish everybody a great trading day. Tomorrow is going to be really exciting on the F.A.C.E show because we're going to have retail sales live right here, so don't miss it. Michael, Ryan, thank you guys.
Cheers, guys.
Cheers, mate.
All right, you guys have a great day. Good luck today. I'll catch you on the morning edge in about 15 minutes for the Forex Analytics community. Until then, I'll see you guys tomorrow on F.A.C.E. Have a great day, guys.